Hi everyone, Piers Bolger here, the Chief Investment Officer at Viridian. Well, we're just through the most recent reporting season for the Australian equity market, and we thought it'd be worthwhile just sharing with you some of our thoughts and some of the key takeaways that we saw over the month of August, and how we're then translating some of those key themes across our two equity portfolios. At a headline level, the market was up close to 3%, 2.8% over the course of August, so another good solid month returns from equities, really continuing on from what we saw through the second quarter of 2020 after the March lows. Two sectors really stood out in terms of overall performance. IT tech-related sector was up close to 15.5% over August, as well as consumer discretionary, which is up close to 8%. So both those sectors have really benefited from e-commerce, as well as obviously the demand side that we're seeing, particularly in terms of cloud and data warehousing. On the flip side, the utilities and communication service sectors were the two weaker sectors over the month, just down around about 5.5% over that period. But more importantly, we did see all other sectors deliver positive performance. So from that perspective, we think the breadth of the return profile was actually quite positive, but again, really being led by just a couple of sectors, which is something that we've seen over the last couple of months particularly. And we've just got a couple of charts here just to sort of show you what we saw across the broader market, and as I said, how we're then positioning some of those key themes across our two equity portfolios. And this first chart here is just really highlighting where the performance has actually hit relative to analyst or broad market expectations. And you can see here that by and large, results were broadly in line with expectations. Clearly, there were some companies that missed. Some of that was already flagged to the market through the months of April and May particularly. But you can see there, whether it be in terms of sales, earnings or dividends, there really wasn't too much outside what the market was expecting. You can see there that certainly most of it was either in line with market expectations or particularly pleasingly was slightly above what the market was expecting. And from our perspective, probably the most interesting one when we look at that was what we were seeing on the dividend side of things, where we did see, as I said, slightly higher expectations of returns. And a lot of that was coming from materials, mining sector, as well as what we were seeing in healthcare. And as I said, both in terms of consumer discretionary as well, where performance, as I said, was certainly very, very solid. However, when we look at obviously that side of things in terms of where we were, we really then start to focus on what it means for 2021, and from our perspective, that's probably where we start to see the more significant level of divergence in regards to the conversations and the presentations that we were having with CEOs and CFOs over the period. And you can see here, both in terms of sales, forward-looking on the earnings side of things, as well as dividends, we're seeing a complete reset in the context of what FY21 might look like. And from our perspective, that's not surprising given what we've been dealing with in regards to COVID and the economic impact that that's been having on many corporates domestically as well as what we're seeing around the world. But certainly from that perspective, you can see that there's quite a significant expectations of just slower corporate earnings growth coming through, and really just highlighting what you're seeing there in terms of the earning per share revisions through FY21. Quite a significant downgrade in terms of that relative to where you would expect, as I said, a more positive uplift. So from our perspective, when we're thinking about that in the context of portfolios, it certainly does mean that we're really focusing on quality. We're really focusing on those businesses that have a sustained advantage relative to their peers. They have strong balance sheets. The ability to really generate good cash earnings, we think, is going to be particularly important as we head through the back end of this year into FY21. And equally, as you can see there on the dividend side of things, certainly we're not expecting a significant uptick in dividends through the course of next financial year. In fact, we probably would expect dividends to remain lower for longer as many corporates start to, as I said, rebuild their balance sheets and ultimately look to grow their earnings over time. So not an inconsistent outlook from what we've been saying in terms of the overall performance of many corporates over the last 6 months from our end. However, when we're translating that in the context of our portfolios, we thought it'd be worthwhile just focusing on some of the key thematics that we've been looking at, the way that we're then positioning our portfolios accordingly. And we've really bucketed this into 4 key themes: defensive, quality growth, category leaders, and recovery leverage. And you can see there under each of those four categories, the types of businesses that we feel can really take advantage of each of those key themes and play a really important part in the overall construct of delivering a holistic portfolio outcome. The defensive side of things, these are the types of businesses that can track through difficult market conditions. You've only got to look at Woolies as a really good example on that front. Really shone through the period of February, March with the lockdown and people obviously increasing their goods in order just to be able to not necessarily go out. We saw that, as I said, with significant uptick in sales. Brambles, obviously the mover of fast-moving consumer goods through their pallets. Next DC on data and cloud warehousing, again, really important that we've seen in the context of e-commerce, and a company like Steadfast, which is in general insurance, which is really, as I said, has a very low correlation to what we've been seeing more broadly in terms of the impact of COVID. So from that perspective, we think those defensives really form an important part. We then sort of move into what we would sort of say quality growth and category leaders. So those businesses that can continue to grow through what has been a very difficult period, but equally those businesses that we would say are absolutely at the forefront of the industries that they operate in. And that means that they can, as I said, take advantage and have the strength, not only from a product perspective, but equally in terms of the way that they have their balance sheets and their ability to be able to, as I said, handle a lot of the challenges that we've seen. And you can see there businesses such as Goodman Group, logistics, industrial warehousing has really benefited from the rise in e-commerce and what we're seeing there. Wesfarmers, again, has continued to be able to trade through and has been able to manage the way that it's been delivering its product to the market. And then you've got CSL, which continues to be a market leader, not only in terms of vaccines, but equally in regards to blood plasma, not only domestically, but globally, and has continued to be able to play that theme. And then Tyro and Xero, particularly in regards to the growth options that we're seeing in Tyro, but Xero obviously a market-leading cloud accounting software. So from our perspective, all market leaders are continuing to provide very strong options going forward. Category leaders, James Hardie, ResMed, Altium, Baby Bunting and A2 all operate in different market segments, but they all have some really key thematics that we believe will continue to see them grow both organically, but equally have the operational leverage that we think can continue to take advantage as we move through a post-COVID phase, certainly into recovery. ResMed, I think, has been one of the biggest advantages of that, obviously renowned for its sleep apnea devices, but its ability then to be able to provide ventilators, as an example, in the US, and to be able to pivot some of its business, we believe, has been really, really positive for the outlook for the group going forward. Baby Bunting, another one that has clearly benefited from the e-commerce side of things, and by and large has been really quite resistant in the sense of the impact of COVID. As I said, from our perspective, it's really developed its online sales process. It's got a dominant position in the infant market, and has really, as I said, continued to be reflected in the overall performance as well. And A2 very similarly on that basis as well. And then we've got those businesses that we think are really linked to a broader based recovery, particularly in the material side of things. We think that's going to continue to provide some really strong optionality in terms of performance going forward. So BHP, broad-based diversified company in terms of obviously its mineral resources. And then you've got sort of specialised companies such as Oz Mineral and IGO. And Oz has also got some linkages there, mainly on the copper side of things, but also has some linkage to gold production, which again is a little bit of a natural hedge in a more challenging market environment. And then IGO on the nickel side of things. So particularly copper and nickel, we think are going to be two resource commodities that are going to really benefit as we move through post-COVID, and equally over the next sort of 5 to 10 years as well. So we think there's some real benefits associated with that. And then Transurban, obviously from a toll road point of view, has clearly had a significant few months just with post-COVID and the inability of people to be able to travel outside, obviously, large haulage. But we think that, the overall concession nature of that business, the strength of that business will start to rebound as we move through into a post-COVID phase where people can, as I said, start to travel around a little bit more freely. And we think that the volumes will more naturally pick up, and that will ultimately feed through in terms of the bottom line for Transurban. Equally, clearly, it's got both assets domestically as well as in offshore markets, the US predominantly. So we think that, as I said, it can continue to deliver on what it has done over the last couple of years, but as I said, positioning for that recovery leverage. So hopefully that just provides you with a couple of key themes, a couple of the major positions we've got across our portfolios. Ultimately, these are always changing in a dynamic nature that we operate in terms of financial markets. But, the way that we've been thinking, we continue to believe that there is significant opportunity. We need to balance that not only with what we're seeing in a domestic macro level, but equally what we're seeing in offshore markets. But from our perspective, as I said, we think that these businesses and others can continue to grow and can continue to deliver really solid investment returns for investors over time. As always, if you have any concerns or queries about your portfolio, please feel free to reach out to any one of our advisors. Thanks and bye for now.